Okay, welcome traders and investors. Todd Gordon here, founder of Inside Edge Capital and tradinganalysis.com. Sorry for the, I had a little bit of a mess up in the hour schedule here. Let me turn this down. We'll get rolling. And let me make sure we're good there. Okay, just let me know. Can you guys hear me okay? Does it sound all right? Just type in a little yes, and we'll get rolling here. But I have kind of some fun, some unfortunate stuff to share. You know, in this incredibly tricky time here in the economy here. So we'll get rolling and hopefully make this educational and worthwhile for you. All right, so this is the market update for October 25th, 2023. We are officially launched. The new website, Inside Edge Capital, is up. We'll talk about that. And, you know, this is speaking to my investors at Inside Edge. This is the first of weekly communication that, you know, the day is going to be determined, but we're going to have a weekly communication going out to all investors to let you know what's going on. We are an active management RIA, and this is certainly a time in the markets to be active. So hopefully we can shed some light on some of the forces that are driving this market in here, and hopefully make sense and maybe calm some nerves that I would say undoubtedly are on edge. Okay, let me just get this up here. We'll roll. Okay, here we go. Disclosures, definitely check those out when you have time. We are a registered investment advisor. None of this should be construed as investment advice. This is solely the way I see the markets and what I am doing or intend to do, and the way I manage portfolios at Inside Edge. So this is educational purposes, and this is not an offer to buy or sell any securities. Know your own risk. And anybody who's worked with me in the past know I'm a very clear and big believer in understanding risk, and you know, I never try to paint a rosy picture and say all's well and I have all the answers. This is a long and winding and twisting road to truth in the markets. I've been doing it for 20 years, and the more you do it, the more you get humbled, and that's just, I think, the natural journey. Okay. So as I mentioned, the new website is up. Inside Edge Capital is rolling. A few little tweaks that need to happen, but something that, you know, we've been working on for a while. I originally launched the RIA under the name Inside Edge. I changed it to New Age for various reasons. It did not work. I did not like it. So we're going right back to where we started, and here it will stay. So this is going to be the home. Inside Edge Capital investors will be able to log in and get all their account information and market commentary and financial planning and so on and so forth. Kyle and I have been working on this for a long time. So site is live. And again, now we have somewhere to host all the weekly commentary. So we're excited. Okay, so what we're going to cover here today is going to be these four main points. So we're going to update our targets for the S&P 500. We're going to look at longer dated yields, bond yields, why they're spiking. Is recession imminent? How's the Fed responding? And of course, you know, very unfortunate conflicts in the Middle East and Ukraine, how that's impacting the geopolitical space, and as a result, crude oil, which also impacts those 3 points above. So we're going to try to tie it all together. This is going to be a heavily fundamental and macro discussion, not so much technicals. Those of you who know me on the trading analysis, the research business side, know me to be short-term and technical in that world. But here we are going to be focusing on long-term key drivers, which very much impact all of you short-term traders and investors. You have to know these macro forces because, you know, this is really what's driving the stock indexes here. Okay. All right. So I think the most important thing, as I mentioned, is you have to remain calm in market periods of market volatility. There's a lot of headline news. There's a lot of people vying for your attention, myself included. And of course, the old adage in the media is if it bleeds, it reads. And and that's the case in traditional media. It's the case in social media, new age media. And, we have to just keep our heads about us and not overly react to all of the things that on the surface are spun into, very scary headlines, which you might think would cause a market crash. But remain calm. The volatility is certainly escalated, but are we in a dire situation right now? No, I don't think so. And I'll explain why. Okay, so the S&P 500, this was the target I put out back here in May on one of the communications to investors. And the S&P was at 4195. The S&P 500 was at 4,195, and I had a 5,000 target in the year 2023, which is almost done. That doesn't look like it's gonna play out. I maintain my 5,000 target, but we have to push it to the back half, H2 of next year, 2024. And what's interesting is the 4195 level that the S&P was trading at back in May is actually quite pivotal because we broke above it, traded up to almost 4,700 area there, and now we're back to 4195. So it's kind of timely with this video. So will this area be support? And a big driver that we'll talk a lot about is going to be interest rates. All right. So is recession inevitable with the Fed hiking rates to combat inflation? Okay. Many experts have forecasted imminent recession. And this started all the way back in the beginning of last year, that recession was right around the corner. Still haven't gotten it, right? The Fed has increased interest rates by 5.5% to cool escalating prices following a decade of quantitative easing, which is the Fed buying of bonds to suppress interest rates to stimulate growth in the economy, and their policy response to the global pandemic, right? So is recession inevitable? The answer is no. And I'll lay out a couple reasons why that may be the case. So what are the chances right now of recession? Right now, markets are pricing better than a 50% chance of recession, 56% of the latest figures that I've seen. There's somebody that I follow, I subscribe, I really respect, Ed Yardeni. He's very fundamentally driven. I follow his work, and he was putting a 15% chance of recession. He bumped it up to 30%, so a 1/3 chance. But the point that he says here, markets can live with a 5% yield. And we'll talk a lot about that. But I really agree with him. In fact, I think, a market that's growing, an economy that's growing, and earnings that are coming in as strong as they are, we should have 3, 4, 5% interest rates. We shouldn't be pinned at zero. Which is, something called ZIRP, zero interest rate policy, in response to 2007 and 8. We're past those crises. We need to get interest rates up. And, the shock is we're certainly having some sticker shock, but is it really slowing the economy down? Okay, so what's recession, right? Recession is 2 consecutive quarters of contraction in GDP, negative growth. Well, this is the GDP, okay, gross domestic product, but it is measuring the change from a year ago, which is how they measure it. But they're also looking at it in what we call real terms. There's a difference between nominal and there's a difference between real. Nominal is the headline. Nominal is the headline price that they're reporting to you. Real is a concept that factors in inflation, and it's a really important. It's a key, but it's a subtle distinguishing point between real and nominal. You have to factor in inflation, right? It's the sticker shock of an 8% mortgage is real, pun intended. But if you think about it, if inflation's running 3 or 4%, as a borrower, your 8% that you're paying to pay back that loan is being inflated away. It's actually being decreased. So if you're borrowing at 8%, but your money is being inflated away at 3%, your net cost to service that debt, your real cost is 5%. So if you borrow at 8 and we have 7% inflation, your actual cost is 1%. So that's the idea of real versus nominal. So when you look at recession, or you look at GDP, you look at interest rates, you look at these figures, you need to factor in inflation, which has been largely zero for many years until the pandemic came. All right, so real GDP tried to get negative, which this is when you start bringing in recession, but we've bounced. And we are coming up on a GDP report tomorrow that I want to talk about. All right. So the St. Louis Fed also puts out something called their real GDP nowcast. So they're forecasting where percent change at an annual rate. And you can see this is the zero. This is negative growth below here. We're starting to move up away from that zero line. So we're starting to forecast growth, not just in nominal terms, but inflation adjusted. And as I mentioned, we're coming up on a very big GDP report tomorrow. This is going to be the preliminary GDP for the third quarter. Right now, we're looking at a 4.1% forecast, right? The last one was 2.1. So we're looking for a pretty significant growth here. Now, just to underscore the importance of the GDP tomorrow, see what happens is they release it in batches of 3. So they have 3 sort of versions or 3 updated figures of GDP growth. There's the advanced preliminary, second preliminary, and then the third. So the first one is the most important because that's the initial read, and then in the months that follow, they revise it. So tomorrow is the first read of Q3. The second read will be on November 29 for Q3, and then the final will be December 21st. Another important piece of data that's coming up is the PCE, personal consumption expenditure. This is an inflation gauge. This is actually one of the Fed's preferred inflation gauge. So that's coming up tomorrow. We're looking at a 3.4% on the headline year over year. So anything below that will indicate inflation is lower than what analysts were expecting. And that's also good for the Fed's inflation fighting front. So let's just review here quickly, all right? Going back to your economics class, bonds and bond prices and bond yields, right? So bond prices, as measured in black over here on the right scale, this is the price of the U.S. 10-year Treasury. It's been dropping since 2020. Equally and on the opposite side is the yield on the Treasury. As the bond prices are going down, the yields or the interest rates are going up. All right, now think about it this way. So, if you issue a bond at $1,000 and it pays $100 a year, right? So it's a 10% coupon. If the price of the bond, which is traded, second by second, just like shares of stock, if the bond goes from $1,000 and trades up to $1,010 and $1,020, but still pays that $100 a year coupon, the percent of 100 compared to the price of the bond, which is $1,020, $1,030, $1,040, $1,050, the percent gets lower. It goes from 10% to 9.9 to 9.8 to 9.7. So as the bond price goes up, that $100 coupon payment becomes a lesser percent. As the bond price goes down, that $100 coupon payment becomes a higher percent. So if the bond goes to $990, $980, $970, that $100 payment becomes a higher percent. So that's why these two move in opposite direction. The 10-year yield is the key interest rate in the economy. That drives where 30-year fixed mortgages go. That drives where auto loans or credit card loans. That's the key interest rate that drives the American economy. So there's make no mistake about it. The key macro factor that's driving equity volatility is this yield. And the technical work we do on my short-term research business, there's 2 zones of resistance that I really would like to see hold. The first one is just above us at 5.17 to 5.48. We traded up to 5. We've backed off back below 5. Right now, the 10-year yield is trading at 4.90. So we're 0.1% below 5. I'm okay if they want to go up and test 5.17 to 5.48. If we don't hold that zone, the next zone is all the way up around 7%. That could be problematic. Okay, I'm going to come to you and say now, I am right now still bullish on the market. But if we get a push above 5.5 and we start moving into 6s and 7s, that could start to become a real problem. Okay. Now, why are bonds being sold? Okay, this is a very deep question. One of the main reasons that's come to light recently is the fiscal mismanagement of our U.S. government, right? So our total debt, how much money we owe the rest of the world in the form of treasuries, is now running at it's like $33 trillion. It is running at 120% of our annual GDP, right? And the blue histogram is a chart of that. So we owe basically 20% more than the total, productivity, both onshore and offshore, of the American economy. Okay, so that's becoming problematic. The other thing that just came out is the government's fiscal year just wrapped up, and we just came out at a $1.7 trillion deficit. So what that means is we spent 6.1 trillion and we took in 4.4 trillion. The biggest source of revenue for the U.S. government is individual income taxes at 2.1, like payroll taxes, Social Security or social, insurance, retirement payments to the government, 1.6. And then this one is interesting. Corporate income tax is only 420 billion, right? So in a way of looking at it, individuals are paying 5 times more to the government than corporates. I kind of have a problem with that. And I'm a capitalist. I have a problem with that. And then here's the outlays, right? So it's a combination of our total debt to GDP and our 1.7 trillion deficit, too much spending, that is causing markets to reprice how much the government and at what price the government can borrow. So now the higher the price that the market makes the U.S. government borrow, the more, I would say, unstable, or the less that the markets will trust our ability to repay those obligations, right? And with the ridiculous bipartisanship that's happening in Washington, they can't settle on a speaker, indicting former presidents, just the horrible political climate we have, nobody can get along. The markets are saying, guys, clean up your act. You guys are acting like idiots. And, and it's costing us now. We are on the way to our net interest, the money it takes to service our debt, which increases as interest rates go up, is going to surpass our total defense budget. Like that's not good, especially in this climate. All right, so the yield curve. Okay, now we talked about yields, all right? And let me just pull this over just to kind of pull the point home here. We talked about yields going up to 5.25. Would not want to see them much above 5.5. If we get up above this zone, this could be a problem. As I said, up to the 7%. The relationship between the 10-year yield and the 2-year yield is something that's called the yield curve, and that's often referred to in the media. The 2-year is going to be reflective of where the Fed is setting their short-term policy rate. Every time the FOMC gets together and they set rates, it's really impacting the short end, which is the 2. The relationship between the 10-year yield and the 2-year yield is the yield curve. It's confusing, but as an equity investor, it's really important that you at least have an idea of what's going on here. It's what's driving the stock market right now. So right now, as this graph, looking back to 2020, is in the red, this means that the short-term rates are higher than long-term rates. Specifically, we got down to 1%. The 2-year yield was 1% higher than the 10-year yield. Normally, longer-term yields should be higher than short-term yields. That's called a normally shaped yield curve. Well, we got to some pretty significant inversion. And a lot of people, will talk about this next, would say, oh, we're coming to recession, sell stocks because the yield curve is inverted. Well, there's 2 things. One, that's not exactly right. And number 2, even if it was right, we are coming out of inversion. We had 1.06% of inversion. Right now, when I captured this, we are at 0.14. So 0.14% of inversion. Basically, the curve is flat now. Short-term rates are basically equal to long-term rates. This is the nominal. Remember that concept of real, factoring in inflation, and nominal? Well, if you look at expected inflation and factor that into yields, which is important, again, on the headline, oh man, an 8% mortgage sucks. But if your debt is being inflated away at 5%, your real cost to borrow is 3%. But if interest rate outlooks are going to go down, but your borrowing cost stays the same, that starts to suggest that, your loan is going to continue to be expensive. But if we factor in where markets are expecting and pricing inflation to be 10 years out into the 10-year yield, subtract that from where inflation is expected to be 2 years from now into the 2-year nominal yield. This is called the real yield curve. The real yield curve also went negative, but what it did is it just went positive. It got out of inversion. That's significant. Now, a lot of people, and analysts, people that I know on CNBC are like, oh, yield curve inversion means recession, sell stocks, just blanketly. You're kind of suffering for something called recency bias and sort of finding facts to support your narrative. There's been, of the 8 times the real 10-2 curve crossed back above zero. So what that means is when you're red, flip back above zero. When you're red, flip back above zero, red, flip back above zero. Of the 8 times since 1980 that's happened, 5 of those times, the S&P is higher next year. They all have recession. Recession part is right, but it doesn't mean the stock market's lower. 2 times, the yield curve goes back above zero. The S&P is lower the next year. And the 2 very prominent times were 2000 tech crash. So look, red went back above zero. Stock market topped. We went into recession, and the blue line, which is the S&P, sold off. 2007 and 8, we went out of inversion, moved up, stock market topped as the housing market was about to crash, ran into recession, which is this gray shaded area, and the S&P sold off. There's 2 significant times, and that's what people are citing. Yield curve inversion equals recession equals stock market selling. Yeah, but what about the other 5 times that inversion went back above zero? Beautiful stock market buying opportunity. Inversion went back above zero. Stock market buying opportunity. Yes, we went into recession, but the stock market really just came back to retest the price and then moved higher. Great buying opportunity, and 2020 buying opportunity. So of the 8 times, 5 of them the S&P was higher, 2 of them were negative. We'll see where the 8th time goes as we look forward a year as the real yield curve is moving back out of inversion. Okay, so we understand the market forces drive the 10-year and 30-year treasuries along with something called quantitative easing and quantitative tightening, which is the government's buying and selling of bonds. They're largely stepping out of the market. What the Fed is very active controlling is the short end, which is really the 2-year, the 1-year, and the 3-month treasury bill rate. So the Fed meets on a fixed schedule to move interest rates up and down. Now, the thing that's scaring the market is if the Fed is going to give us some clarity as to when they're done hiking short-term rates, right? It's not the level. I used to trade FX for a hedge fund on Wall Street, which is very interest rate driven. It's not the actual level of interest rates that will unsettle a group of investors or a corporation or an economy. It's the uncertain future trajectory of rates because you can't plan. It's not an absolute level of rates that unsettles investors. It's the uncertain future. So while the Fed isn't giving us any real clarity as to when they're done raising rates, the markets are now telling us there's a 98% chance that they're going to stay on hold at current levels of 5.25 to 5.5. And that was 70% chance a month ago. Now we're at a 98% chance that they're done. And for the first time in over a year, we're actually seeing a small chance, only a 1% chance of a cut. First time we've seen that. Looking out to the December meeting, okay, we're at 5.25 to 5.5. Right now, the markets are pricing a 74% chance that we're on hold. Only a 24% chance that we're going to go another quarter point. And that was as high as 36% a month ago, 32% a week ago, and now we're settling in at 24%. So not going to hike in November, and there's only a 0.25% chance that they're going to hike a quarter in December. And as we look forward, the best odds are we're going to stay right where we are, 5.25, 5.5. We're going to have some visibility on what they call terminal Fed funds rates, which is when they're going to be done hiking, despite what Powell says to us, which he usually clubs us over the head with something. We're going to be higher for longer, and we're resolute on a 2% inflation target. So after he's done verbally abusing us, which is fine, the markets are saying he's done. And then the first cuts are the best odds of a cut are coming in June, 56%, 74%, 90%. So markets are really pricing in a cut into the summer 24. It's a long way away, we'll see. Okay, but the point is, do we have visibility in the end of rates, at the end of the rate tightening cycle? Okay, just watching the market over my shoulder here. How's everyone doing? Everyone good? Confusing? Everyone making sense? I'm live streaming this. Chris, 3-month, I have that in a different chart. I can show you 3-month and 2-year after this, but it's a good question. Okay, are we going back to 70s? Are we in a stagflationary, persistent inflationary, no growth period like the 70s? I don't think so. And this is what the core CPI, so consumer price index, core is excluding food and energy, right? And a big driver of headline inflation in the 70s was crude oil because of the Iranian oil embargo, right? Well, inflation was running really high back in the 70s, coupled with no growth. We have growth. And if you look at the core CPI, we're nowhere near where we're in the 70s. So are we going to do a double spike? Maybe, but some exogenous shock that we're not talking about right now has to enter the equation to create a scenario like this. I'm not saying it's not going to happen, but, and again, you don't get hit by the train you see coming, but there's nothing here to say that we're going to have a repeat of the lost 70s. And here's a big factor why this is not the 70s. Remember I talked about, your headline interest rate, but when you factor in your inflation, what's your real cost of money? The real cost of money back in the 70s was significantly higher than where we are now. And in fact, we've been downtrending through the 21st century. Okay, and you technical types out there will notice we have a little bit of downtrend resistance here as we're at a 1.2. So what's the real cost of money? You take the Fed funds, which is I just showed you on the last slide, is 5.25, 5.5, and you subtract core CPI. That's the real cost of money. It's fine to borrow at 5%, but if you're running at 3% inflation and you're borrowing money, inflation works for you because your debt service is going to be inflated away. So your real cost is 2%. If you are a creditor, which means you're buying someone else's debt and you're receiving a coupon payment in exchange for them borrowing money from you, it's a fixed payment and inflation's going up, that works against you. So if inflation is viewed to be high for long periods of time, bond investors will turn away from that investment because a $100 fixed coupon payment is going to be worth less years down the line as inflation goes. So for creditors, inflation does not help. For debtors, inflation does help. Okay? So the point is, the real cost of money for those of you who want to borrow money in this economy is nowhere near as bad as it was in the 70s. It was 8-9% was your real cost of money, where now Fed funds minus core CPI is about 1.2. So it's not even close to the 70s. All right, so we're looking at some of the factors within CPI. So we have CPI coming up here a couple weeks. We have PCE Friday. And I am sourcing Ed Yardeni again. Again, I really like his research. You can find his stuff for free on the internet. Definitely check it out if you're into the fundamental stuff. He's making the point that if you look at core CPI, but you strip out housing, and a lot of people are saying that the housing numbers that the Fed is using are stale, stagnant, don't update in real time, and you're using old data. It's going to take a long time for these higher interest rates, which are sort of choking off the housing market. It's going to take a long time for those to filter into the CPI readings. So he is showing us in the red dotted line here, if you strip out shelter, the CPI, the core CPI, ex shelter, is hanging right when inflation wasn't even a topic of conversation. In fact, the opposite was happening, which was deflation, disinflation. So, if you take out food, energy, and shelter, which I know that's a lot, but energy we know is volatile for geopolitical reasons. Shelter is clearly lagging numbers. And the Fed could use more real-time data like Redfin or Zillow or something like that and get a better read on what shelter is actually doing. Might give you a better inflation picture. This chart is showing that the rent component, shelter within CPI, is starting to turn over. So rent of shelter, what they call owner's equivalent rent, and then rent of primary residence. I mean, it's still elevated, but it is starting to finally come off. So that will filter through into your CPI numbers in coming reports. All right. So let's talk about why bonds are moving lower. Remember I showed you the price of the 10-year Treasury in black was moving down, yields are pushing up. Well, why is that happening? Okay, at first blush, when I was watching everything that's going on and the horrible situations overseas, I was thinking, well, foreign governments are selling our bonds because they don't like our policies, they don't like the way we're managing our fiscal house, or they're just trying to sell treasuries to raise money to fight wars. It's, after some examination, I found out that that's not really the case, and I'll show you why. So here is all of the holders of U.S. Treasury, which right now is about $33 trillion. The orange part here is foreign holders of our debt. Okay, so the foreign holders of our debt in orange winds up being 7.7 trillion of the 32 trillion outstanding. 7.7 of the 32. The rest of it is, the big one is Fed and state governments. Blue is mutual funds, depository institutions, state and local governments, pensions, insurance, etc. So, they hold, call it 8 trillion of the 32 trillion. What is that? I mean, that's actually not right. It's not 10. This is a note. I should have cleaned this note up. This was a message going back and forth with my research team. So 8 is a percent of 32. So, I actually got to change that. It's about 25%. Okay. What I'm saying here is my thought was China was selling a lot of treasuries. China holds 800 billion of U.S. treasuries of the 7.7 trillion held overseas. So call it 800 as a percent of 7.7, 10.5, 11, 12%. Of all the governments that hold our treasuries, China only holds 10% of them. It's not so significant, right? And Russia was holding about 100 billion and dropped it down to 14 back in 2000. Actually, that's 17 and 18. Okay, so it's not really China that's crushing us. China is continuing to sell because they have their own problems. They have GDP growth that's flat. They have disinflation and almost deflation. China's not doing well economically. They are selling treasuries because they may need to raise money. The trade relations with China are disintegrating. There's a lot going on with our semiconductors in China. NVIDIA is under pressure because of it. But China net for the year has sold 51 billion in treasuries. But what's interesting is other sovereigns, other countries are buying. Cayman Islands bought 60 billion this year while China has sold 50 billion. So Cayman Islands are absorbing China's sell. It's not really that's really hurting the supply of treasuries. I think it's coming domestically, and it's a combination of inflation and also I think the bad fiscal situation the U.S. government is currently in because of the extreme bipartisanship and fighting and acting like children, right? So I think the markets are repricing how much it costs to lend money to the U.S. government. They're like, get your act together. So hopefully the politicians take that as a sign. They probably won't. But hopefully you take it as warning that you got to tighten up the ship here and start acting like adults. So the people selling these bonds, they are going to be, they are, government entities, as I mentioned, but they're also something called bond vigilantes, right? Bond vigilantes. Investopedia defines them as a bond trader threatens to sell or actually sells a large amount of bonds to protest or signal distaste with policies of the issuer. So bond vigilantes are protesting the fiscal management of the U.S. government. Now, when you first think of the word vigilante, I think of a negative connotation, right? But if you think of the root of the word vigilante, it's to be vigilant, which is to watch or be aware of a situation. So, if you think about it, all right, maybe it's not such a bad thing. Governments perhaps should heed the warnings of the vigilantes. Bill Ackman's one of them. He's a major hedge fund guy. He was short treasuries and just covered them. His cover is short, and it was a big headline news. He's just saying there's too much risk in the world to bet against bonds. So, a big bond vigilante like Ackman just covered his shorts. Well, remember, if people are short bonds, they sold them, pushed the price lower, they got to buy it back to cover, and those people covering shorts are creating a floor in the price of the bond, which means a top in the yield, right? Bond prices and yields moves opposite. So major vigilante covered a short. Okay, let's talk about crude oil. And this is all very much related. So oil prices regained stability, right? So there was an initial shock up to 90 on the horrible events that happened in the Middle East. And since then, crude oil has come off. Okay, there's also news that we're trying to lift sanctions with Venezuela to start importing, and they're also going to be refilling the SPR, which is the Strategic Petroleum Reserve, which, that's that. So crude oil is really under control. It's not driving too much market volatility. And at first blush, you're like, oh my gosh, the headlines which I've seen, and this is again not overreacting to headlines, is if Iran becomes entangled in this and they fall offline as a supplier of crude oil, what's that going to do to the crude oil market? Well, there's sanctions on Iranian oil, Western sanctions as it is now, so we can't, we're not supposed to be, Russian or Iranian oil, but they're still getting it out there, China. But if they were to completely come offline, how much of the daily supply of crude would be lost? Well, there's a 97 million barrels per day being supplied to the market. U.S. is 20 million. Iran is 3 million. Okay, it's like 3%, 3.5%, whatever. It's pretty small. So that could be made up very easily. What's also interesting is the U.S. is producing 20.3, but consuming 19.8. So we're a net producer of oil now, right? China is consuming 15 million barrels a day and producing 4, so they're a net consumer. Russia is producing 10, but consuming 3, so they're a net exporter, right? And Iran, nowhere over here in consumption, but again, 3-4% is what they supply to the market. So that's why there's not a huge push in the crude oil market that's disrupting. And crude oil, from a global macro point of view, is impacting interest rates. Interest rates, from a global macro point of view, are certainly impacting the stock indexes, right? And it's all very much related. It's commodities, it's currencies, it's interest rates, and it's equities. As an RIA, as a money manager, as a research business owner, it's all very much interrelated, and it's been very busy lately. All right. But good news is we are we're a long, long way from default, Corbin. Long way from default. Good news is we are now in earnings season. Okay. We had 2 big reports last night. We had Microsoft, which crushed it. Great report. We had Alphabet, which is Google's, that also beat earnings expectations, but their cloud numbers were a little low, so the stock's under pressure. It's all about those cloud and profit margins right now. But we are now fully in earnings season, okay? Tonight, we're looking at Meta, IBM, ServiceNow. You can see everything that's going on here. Tomorrow morning, we have UPS, Hershey, Altria, Southwest, and then Thursday after the bell, Amazon, Intel, Chipotle, Ford, big names coming out. And then Friday morning we've got Charter and then Chevron, Phillips, AbbVie. So we are now well in earnings season. Then the week after is going to be Apple. So we are very much with Thursday tomorrow, which is GDP, and then Friday's PCE, personal consumption expenditure. We also have earnings season, so it's very, very busy right now. Okay, let's talk about earnings. All right, this is coming from FactSet. What they do is the analysts get together and they say, here's how much we think the S&P 500 companies are going to earn for calendar year 2023. So, you take all the S&P 500 companies. One company makes $1 a share. Another company makes 50 cents. Another company makes $8 a share. You add it all up. All right. They're looking at collectively for calendar year, this year, 2023, over the 4 quarters, to make $220 in earnings per share. All right. These are the estimates for 2023. Now, I've seen estimates last year for 2023 of $190, $200, $205, $210. Well, now we're at $220. So people who are forecasting recession were also looking for $190 of earnings for calendar year 23, and now we're up to $220. Look what next year's at. They're looking at $247. So what is $27 as a percent of $220? That's more than 10% growth forecasted for next year in earnings. This is EPS, earnings per share. That's net revenues. Okay? If we break it down to the quarter, we're now reporting Q3 of 2023. So this is where we've been, and now this is where we're expected to go. You can see an upward trajectory, $55 a share, and then Q4, which will be reported early next year, $57, $57.70, $60, $63, $65. Then all of a sudden, when you start adding these up and you look at the expected growth rate as the Fed stops raising rates, as supply chains continue to ease up, as shelter, housing market calms down, as the flight out of the cities post-pandemic, auto prices calm down, you stop seeing used cars be as expensive as new cars, which is insane. This is still post-pandemic supply side price increases. This is why you can't look at the yield curve inversion from 2000, 2008 and extrapolate it into today. Those were demand-driven interest rate increases by the Fed to calm the economy down. This is a supply side. This is not an overly heated economy where consumers are going crazy and bidding up the price of goods. This is a supply side where there's not enough goods to supply the demand from the consumers, so prices go up. It's post-pandemic. That's why we're seeing, and that's why it's not the same as what we had in 2000 and 2008, where we had runaway economies from very cheap borrowing costs, and the Fed said, whoa, calm down, everyone. We're going to be driving inflation, and that's why the Fed raises rates. Well, the Fed raised rates, but again, it was in response to supply-side price shocks. All right, let's look at seasonality. All right, seasonality. We look at the S&P over the last 73 years. October, November, December. On average, the October S&P is up about 1%. We're down about 1% right now. November winds up being the best month of the year for the S&P. December, the second or maybe the third best behind April. So the point is for Q4, the average of the last 73 years is over a 1% growth, 1% increase in the S&P and Q4. NASDAQ, good October month. We're down 0.6 right now in the NASDAQ composite. November, over the last 1972 to 23, so what is that, 28 plus 23, 51. Over the last 51 years, on average, November is up better than 1.8, 1.9%, and then December's there. So this is what, this is sort of Q4 is a very seasonally strong period. Same with the Russell. Okay. All right. That's going to be a wrap there. So kind of tying it together. Oops. Maybe I wasn't sharing. Sorry. I don't think I was sharing my screen there. Oh, man. Where did I lose you guys? Thanks, Ivan. Sorry about that. So just showing you, hopefully, just to show back those screens. Again, I hope I was sharing right here. This is the EPS for the year, $220 a share. This is EPS for the quarter expected. There's seasonality, okay? So seasonality, October, November, December, for the last 73 years, anywhere from 0.8 to 1.2. NASDAQ, 0.7 up to 1.8 to 1.2. There's the Russell. So seasonally, we're coming into a strong period. Sorry for not sharing the screen there. Okay, so that's a wrap, guys. Just to get you updated again, the first of many weekly updates for investors of Inside Edge. I'll put some public stuff out there as well. And, you know, it's a very interesting time. I'm watching the markets. Watch those interest rates. Those 10-year yields are going to be very, very important. Watch where GDP comes in. Watch where inflation comes in. And really watch where earnings come in here now that we're fully underway in Q3 earnings. So markets are off. I don't think it's time to get super defensive right now. If we continue to see escalation in interest rates, I will get defensive. I will adjust the portfolios. I will establish some short exposure and on the research business and on the money management business at Inside Edge. So it is a very, very busy time. So thanks for hanging in, guys. I hope that helps. And I will see you on the next video update. Thanks for hanging out with us. See you guys.